Okay, if you're an experienced worker, maybe age 50 or over, and you're really trying to maximize those retirement savings,
Yeah,
the rule book feels like it's constantly being rewritten.
it does, yeah.
And right now, there's one massive federally mandated adjustment that's coming directly at, well, potentially at you.
Mm-hmm.
Today, we're doing a deep dive into the specifics. It's a really substantial mandatory shift. It comes from the Secure 2.0 law, and it's all about 401k catch-up contributions.
That's the one.
Our mission for you is pretty simple. We wanted to decipher exactly who is forced to change their saving strategy when this mandatory Roth contribution thing hits in 2026. And this is crucial. What administrative hurdle could actually block high earners from contributing entirely?
That's right. It really is a paradigm shift for tax planning. And like you said, mandated by Secure 2.0, passed back in 2022.
Right.
And the core mechanism, it's actually straightforward on the surface. Certain high-income older workers, specifically those age 50 and up, well, they won't have the choice anymore. They can't use pre-tax dollars for catch-up.
No choice.
Nope. They're being forced onto a Roth basis. That means contributing with after-tax money.
Okay, so let's define the target then. Who exactly gets swept up in this mandate? Because you need to meet two very clear criteria, right? And I think this is where people might start getting a bit confused about whether it applies to them.
Exactly. Two key things.
Okay, so the first one is age. You have to be 50 or older. That's just the baseline for making any catch-up contribution anyway.
Standard rule, yeah.
The second criterion, that's the income part. You need to be earning over $145,000. Now that figure, the $145,000, that's what we're using today, but it is indexed to inflation, so you should probably expect that number to tick up a bit by the time this rule actually takes effect in 2026.
Good point. It will likely increase.
So the bottom line is if you're a high earner and an older worker, your retirement strategy, well, it just got a lot less flexible.
It did. And while it's slated for 2026 now, that timeline itself caused massive headaches. Across the whole financial industry.
Oh, I remember that.
Yeah. Secure 2.0 originally intended this Roth mandate to start way back in the 2024 tax year.
So now, basically.
Right. But employers, record keepers, they just couldn't pivot their systems fast enough. It's a complicated shift for payroll. So the IRS, they stepped in and postponed the effective date for 2 years.
Okay, that makes sense. Bit of breathing room.
Exactly. So you, the employee, have until 2026 before this really affects your paycheck contributions. But that's just the employee side. Employers, they actually have until the 2027 tax year to get fully compliant with all the, the underlying regulatory details.
Ah.
That delay is crucial, and it gives us time right now, like we're doing, to figure out how to plan around it.
Right. That breathing room is good. It lets us pivot from when it happens to, well, who is actually making these contributions? And how much do they stand to lose if they get caught flat-footed by this? We should probably define catch-up contributions again, just in terms of the actual dollar amounts involved.
Good idea. Context matters here.
So we said you have to be 50 or older to be eligible. The current limit for those extra contributions, it's pretty substantial. It's around $7,500 on top of the regular maximum employee deferral.
Which is already a decent chunk.
Absolutely. And then there's that special group, right? Workers age 60 to 63. For them, it's even higher.
The super catch-up.
Yeah. We're talking, potentially up to $11,250 in catch-up? So a total limit way up there. These are significant amounts that high earners often rely on, to really top off their savings later in their careers.
Absolutely. Critical amounts for some savers. And let's clarify that $145,000 high earner threshold a bit more because listeners need to know precisely how the IRS measures that income.
Okay.
For your 2026 contributions, the IRS is going to look back. They'll look at the wages reported on your W-2 form from the previous year, so from 2025.
Got it. Previous year's W-2.
But here's the specialized detail that often catches people off guard. That W-2 wage check, it's specifically tied to the income you earn with your current employer.
Okay, wait. That raises a really interesting question then about eligibility. Let's say, hypothetically, a 50-year-old worker switches jobs mid-year, say mid-2025.
Okay.
And maybe they only made, say, $90,000 with the new company by the end of 2025, but they had already made $80,000 with their old one before they left. So their total income for 2025 is over the threshold, right?
Yeah.
$170,000.
Right. Total income is over.
So how does that complication play into their 2026 catch-up eligibility at the new company, given the rule is tied to the current employer's W-2 from 2025?
That's exactly the kind of nuance you have to track carefully because that calculation, it is tied specifically to the current employer's W-2 wages from the prior year.
Right.
That hypothetical worker, the one who switched jobs, they would likely not be considered a high earner by that new employer for 2026 catch-up purposes.
Even though their total income was higher.
Correct. Because their 2025 W-2 from that specific new firm was under the $145,000 threshold, just the $90,000 in your example. So this makes tracking your own W-2 wages incredibly important, especially for high earners who are near that limit or maybe over it. Particularly if you've changed jobs recently,
Yep.
you need to look at the specific W-2.
That is a critical detail. Okay, so once we know who is impacted and how that income is measured, let's explore the why. Why is this happening? This mandate, it forces a high earner who might normally, want to maximize that immediate tax break of a traditional pre-tax contribution.
No.
It forces them to lose that benefit for catch-ups. Why is the federal government mandating this shift to Roth? What's the precise economic thinking driving this loss of flexibility for the individual?
Well, there are sort of two sides to the rationale. For the worker, the motivation is potentially clear down the road. Roth contributions, as we know, are made with money you've already paid tax on.
Right, tax now.
In exchange for tax-free withdrawals in retirement, assuming you meet the conditions, like holding it for 5 years and being over 59 and a half.
Okay.
So for a high earner, someone who genuinely believes they'll be in an even higher tax bracket when they retire in, say, 15 or 20 years, paying the tax now can actually be a great hedge. It locks in today's tax rate on those pretty substantial catch-up contributions.
Yeah, I can see the future benefit, the tax-free growth and withdrawals. That's huge. But for a high earner today, someone who's already feeling the pinch of being in one of the highest marginal tax brackets now, giving up the immediate deduction on, say, $7,500 of catch-up contributions, that's a noticeable financial hit right now. Are there scenarios where this mandate actually, hurts their ability to maximize their tax flexibility? Is Roth always the best choice for everyone in that bracket?
That's a crucial challenge, and the answer is no. Roth isn't universally better. It's fantastic, but not always optimal.
How so?
Well, think about a high earner who's planning their retirement very aggressively. Maybe they plan to move to a state with no income tax or just a much lower cost of living area, and they anticipate a massive drop in their income. Maybe they'll just live off investments that push them into a much, much lower tax bracket in retirement. For that person, the traditional pre-tax deduction is almost always preferable.
Why is that?
Because they get to defer the tax at their high current marginal rate, maybe 35% or 37%, and then they pay the tax back later during withdrawals, maybe at only 12% or 22%. That's tax arbitrage, basically.
Right, saving the difference.
Exactly. This mandate, it removes that critical planning tool for catch-up contributions. It effectively forces that high earner to accept the Roth benefit for this specific type of contribution, regardless of their own individualized tax outlook for retirement. It's definitely a loss of personal customization in favor of a broader policy goal.
And if we connect this to that broader policy goal, I suspect the biggest beneficiary here isn't really the individual worker, right? It's more about the government's balance sheet.
You've hit it exactly. That's the other side of the rationale and arguably the main driver. This mandate is a huge benefit for federal cash flow. By forcing these high earners to contribute on an after-tax basis, the government gets to collect income taxes on those substantial catch-up amounts immediately, right now, not decades down the road when people finally start taking withdrawals.
Instant revenue.
Precisely. If you look at the economics of it, it's basically a form of revenue acceleration for the Treasury. It pulls millions, perhaps even billions, in tax revenue forward into the current budget window, money that can be used to fund current government expenditures.
So the irony. Secure 2.0, a law that's generally intended to help Americans save more for retirement. This particular provision seems largely designed to optimize federal revenue collection, at least in the short term.
That's a fair assessment of this specific rule's impact, yes. It serves both purposes, arguably, but the revenue aspect is significant.
Okay, that sets up what might be the biggest trap in this whole new law, what we've been calling the critical plan feature loophole. Because this isn't just about switching how you're taxed on contributions. It introduces this massive risk that some high earners might be completely excluded from making these variable catch-up contributions at all.
Right.
And it's basically down to administrative oversight, potentially.
That's the core issue. The underlying problem is that while the law mandates how these high earners must contribute on a Roth basis, it doesn't magically solve the logistical challenge for employers,
It is.
which is that not all retirement plans currently offer a Roth contribution feature. We kind of assume every 401k has it these days, but that's not true. Smaller businesses, maybe certain nonprofits or, organizations running on older legacy payroll systems might simply not have adopted a Roth option yet.
They just haven't added it to their plan documents or systems.
Exactly. And this is where we absolutely need to highlight the exclusionary impact. The IRS clarified this point. If a plan sponsor, the employer, chooses not to implement the Roth feature, maybe it's too costly, maybe it seems too complex to administer,
Okay.
then the higher income workers, those $145,000 plus earners, they will not be eligible to make any catch-up contributions. Full stop. Period.
Wow. So they just lose the ability entirely. They can't make pre-tax catch-ups. And if there's no Roth option, they can't make Roth catch-ups either.
Correct. They simply lose the ability to add that crucial $7,500 or potentially more if they're 60, 63 to their nest egg through catch-up contributions.
Just imagine that. You're a high earner. You've been planning on using those catch-ups, maybe working for an organization that's been a bit slow on compliance updates or they're stuck on an older administrative platform. You could literally lose the ability to contribute thousands of extra dollars just because your employer didn't check the Roth feature box by 2026. It really feels like the participant, the employee, is being penalized for the plan sponsor's administrative lag.
It absolutely is a direct risk for the participant in that situation. And the complexity, it gets even worse because the IRS also clarified that the plan sponsor does not have to eliminate catch-up contributions for everyone if they lack the Roth feature.
Wait, what does that mean?
It means if the Roth feature is missing, all the other eligible workers, so those aged 50 or older but earning under that $145,000 income threshold, they can still continue making their traditional pre-tax catch-ups just like before.
Oh, I see. So the rule splits the workforce within the same plan.
Precisely. You end up with this odd scenario where the lowest paid older workers in the plan can still use the traditional catch-up feature, but the highest paid older workers lose their eligibility completely unless and until that employer adds the Roth feature.
That's potentially divisive.
It could be. So the message is loud and clear. For any high earner listening, checking the status of your employer's Roth feature, like immediately, is a non-negotiable action item. You need to know if it exists or if it's planned.
It really feels like the ultimate example of maybe unintended consequences in large pieces of legislation. A law broadly meant to secure retirement ends up potentially excluding the very demographic that often has the most capacity to save extra, all because of what boils down to an administrative checkbox in the plan.
It highlights the friction between policy goals and practical implementation, definitely.
Okay, so let's try and bring this home. Let's distill the key takeaways for everyone listening.
That's good.
First, if you are an older worker, 50 plus, and you expect to make catch-up contributions, and you earn more than that, let's call it a $145,000-ish threshold with your current employer in 2025, you need to prepare for a mandatory switch.
Right.
Starting in 2026, you must pay income taxes up front on those catch-up contributions because they have to be Roth. So you need to factor that immediate tax liability into your budget now, your saving strategy for 2026.
Absolutely. Plan for that cash flow impact.
The second action item, and honestly, this feels like the most critical one based on our chat. You need to verify today whether your employer's 401k plan actually offers a Roth contribution feature.
Crucial step.
Because that single administrative detail, whether that feature exists or not, will determine your entire ability to make any catch-up contributions beyond the standard limit starting in 2026 if you're a high earner. Yes, compliance changes are messy. They're hard for plan participants, for record keepers, for employers, for everyone involved. But the potential reward for you, the saver, is securing that substantial tax-free growth potential in retirement if you can navigate this hurdle.
Well said. And maybe one final thought if we connect this to the bigger picture.
Please.
Given that this $145,000 income threshold, it is tied to inflation, right? It's going to creep up each year. But wages tend to creep up too. So this mandatory shift to Roth contributions, it's pretty much guaranteed to capture more and more high earners over time.
So the pool of affected people grows.
Exactly, which means it will steadily pull an increasing amount of tax revenue forward for the government year after year. So the provocative question is, what long-term impact will this mandated and growing upfront tax collection have on the overall tax revenue projections for the federal government over the next decade? And, maybe more interestingly, How might that influence or perhaps accelerate the timeline for future retirement legislation? Could it prompt the government to look for even more ways to collect revenue now rather than waiting until retirement?
So the success of this revenue-raising measure might encourage more similar policies down the line.
It's certainly something to watch. That's the potential big financial domino effect we're keeping an eye on.